What's up, guys? Welcome to another Market Radar podcast. We've got a pretty big week coming up. We've got CPI on Wednesday, PPI on Thursday, and we also have jobless claims on Thursday that we are always monitoring. So let's talk about CPI next week. Gamma, what are we expecting?
So CPI comes out on Wednesday. We are expecting CPI to be lower than what the market has historically seen over the past 6 months. Obviously, that means we don't expect a huge uptick in CPI. Now, there's been a lot of comments and a lot of stuff floating around on Twitter and in the financial media that CPI may come in hot. Now, that's subjective, right? Anything above 5%, you could or most likely would be considered hot. But that doesn't really mean it's actually hot. Now, what I have on my chart here is very simple. I have two lines. The orange is the 5-year break-even inflation rate, and these are measured off of Treasury securities that trade on a daily basis. They are the anticipated inflation rate over the next 5 years. I also have in white the CPI year-over-year percentage change, which is what everyone's focused on the reports, on the economic releases, excuse me. So what you do notice when you look at these charts on top of each other is that break evens, which is the orange line, they tend to peak and bottom before CPI. Now, why is that? It's very simple. CPI is a lagging indicator. So the break even rates are traded on a daily basis. They're real time. It's what the market sees inflation being, or inflation expectations being today. So if we zoom in here and we take a look at break evens and what they've been doing the last couple of months, they've been chopping around in this the 5-year break evens in this 2 to 2.4, 2.5% range. What that's telling us is that there's a very good possibility, and we've been very adamant about this, that inflation will slow down and pretty much get snagged up around the 5% range, meaning inflation being CPI, meaning it's very easy to bring inflation from 9% to 5%, but the extra 5 down to 2, which is the 2 is the Fed's target, is going to be a lot trickier than what we've seen in the last 6 months. But that does not mean that inflation has much upside risk. So think of it like this. Think of it as the slingshot. We saw the huge pullback now, and now everything's going to slow down as we get further and further back on this inflation. It's easier to pull the slingshot back from the beginning, and as you pull it back more and more and more, things start slowing down. Now, that doesn't mean inflation is going to ricochet and shoot back right up like a slingshot would. It's the idea that of elasticity, that as we come down, things will slow down. But
a lot of people are expecting deflation coming up, and to really see deflation, we would have to see the 5-year break evens break that low that they're kind of hung up on right now. So what needs to really happen for that to occur? Is it if these CPI numbers all of a sudden start coming in a lot lower than the market's expecting? Is that what would break these 5-year break evens lower?
Well, if CPI really starts coming in under 5, in terms of being consecutively printing under 5 and a lot lower, meaning not 4.89, 4.8, 4.85. I mean 4.9, 4.7, 4.2, and then like something like dramatic like that. What's going to happen is the market's going to anticipate that or at least everyone's going to know, not even anticipate, the Fed has over tightened. Things are contracting much faster than expected. Right now, based on the last CPI print and where the Fed funds rate is today, the Fed is at positive to neutral real policy rates if we were using CPI as the real component, or as the inflation component in that calculation, meaning the Fed has their interest rates at the inflation rate. We've said this pretty much for a year now. That's the Fed's goal. They were able to move rates up in a manner, and inflation came down in such a manner that they are now in line with inflation, and they did not have to chase inflation all the way to the 8s or 9s or 7s with their Fed funds rate. So they somewhat played it rather well here. Now the question is going to be what happens next. For that deflation trade to really trigger, what you're going to need is, like you just said, break evens to fall and break down with some momentum. For example, back in mid to late 2018, when we saw that deflationary move in markets, break evens really were just going down. And then obviously the big deflationary event, COVID, where break evens just shit the bed. And that's really what you want to see, is break evens go down like this in a deflationary regime. If they don't, odds are, based on what they've already been doing here, getting that inflation to really move lower is going to be a bit trickier. That doesn't mean that all of a sudden break evens won't be able to just break lower and start heading lower. But remember also, the Fed policy is lagged by at least 6 months. And if we go back in time, maybe 12 months ago, we were in May 2022, and the hiking cycle was really just heating up. So we've done so much in 12 months that we're going to have to give break evens and the market a little bit of time to absorb and shake everything out. But break evens peaked well before CPI did, and they've been on the downswing ever since March of 2022. So that's showing us that that CPI doesn't really have as much upside risk as most people are talking about, but it does certainly have sticky risk, meaning it can chop in this 5% range for some time.
Right. So the Fed's plan is obviously to hold rates for a while, as they don't want to risk another 1970s situation with that double peak in inflation. So if the Fed does hold rates where they're at right now, or roughly where they're at right now, is the long bond trade still possible in that scenario, or do they need to cut for that trade to really work out?
It's possible, but let's go over the dynamic of why they would cut, right? We know that the Fed has been very vocal about holding those rates around 5, maybe depending. We were looking at a potential June hike, but that's slowly being chopped around and sloshed around the table. It doesn't look like it's going to happen as of right now. But in terms of where the Fed's going to expect to hold their policy, we're looking at 500 basis points, what they've been saying, 500 basis points throughout the rest of the year. Now, why would they cut their why would they cut their or reduce their policy? Number one would be inflation is dropping dramatically, where they are running the risk of holding rates high enough to the point where just holding them is over tightening. Number two would be unemployment picking up. Now, we had unemployment come out this week. The figures came in at near new cycle lows. So not new cycle in terms of the unemployment rate at 3.4%, but they were close. We also had 250,000 jobs created in April. So again, the economy is not really breaking down, and that's what the Fed is going to want to see to reduce their policy rate, accompanied with inflation going down. And remember, they're on this whole program that to bring the market down, to bring inflation down, they need to basically bring the jobs market down, because by ruining demand, you ruin inflation. Now, we know that, again, the Fed policy has a lag effect. So bonds know this too, okay? Bonds are not stupid to where they're going to sit around and do nothing for months until the Fed finally says, oh, it's time for us to cut. Meaning, if break-evens start moving, the bond market's moving. It's rather simple. The reason the bond market hasn't done jack in the last 6 to 8 months is exactly the same reason why break-evens aren't lower. The market isn't seeing that deflationary force pick up just yet. But even if it does, it doesn't mean we're in deflation either. What it means is the market is slowly building towards deflation. Now, what does that mean? Typically, we see stagflation occur before deflation. Why is that? Well, let's understand what deflation is. Deflation is falling inflation and falling growth. But we're going to focus on inflation here. So falling inflation. Well, for inflation to fall, it first has to go up, right? So typically what ends up happening is you get hit with stagflation at or near the peak. And as inflation is falling, even though inflation is falling, it's still so high that you're in the stagflationary regime. And then once inflation really starts falling enough for it to be material within the markets, you then get that deflationary switch. But the market sees this. The market knows this. This is why we have to focus on the market and not the data. The data is lagged, skewed, and revised. It's a bunch of bullshit. The market knows what the market knows, and the market knows it in a relative efficient manner. So we have to pay attention to what the market's saying. So going back to what you were saying in terms of bonds, yes, the bond trade can work. Let's look at bonds compared to the Fed funds rate going back to long bond futures compared to the Fed funds rate going back to 1999. What you'll notice is bonds usually bond lows are made when the Fed stops hiking. If we take a look here back in 2000, when the Fed hit their peak policy in early 2000, bonds didn't see new lows for pretty much this entire time. And when the Fed peaked in 2006, bonds did not see new lows. They got close, but they did not see new lows. And Then they took off. So let's take a peek at 2018. Dude, this fucking bird. Can you hear him?
Yeah.
Dude,
All
oh
right,
my
go
God.
on. Go on.
So let's take a look at 2018. What we had here was the Fed was basically hiking all the way into the early stages of 2019. The bond market, however, started moving well before the Fed actually started cutting. Why is that? That's because the market's forward looking. So, what does this mean? Essentially the Fed can hold rates as they did in 2006, and bonds may not break lower. Bonds may start to build higher, or as they did in early 2000, the Fed held rates for almost a year. Yet the bond market moved higher. So we have to pay attention to what the market is telling us, where the market thinks inflation is going to be, because at the end of the day, the Fed is late to the game. They're late to raise. They're usually late to cut. They're actually more efficient in cutting than they are in raising, and that's just human dynamics, right? It's always easier to release the cash than it is to take it back, and that's really what they're doing when they're cutting rates. It's easier to stimulate than it is to restrict policy. So the bond trade will trigger. It's going to happen, but eventually. And we're highly doubtful that rates will be sustained at these levels for more than 12 months. And realistically, at 5%, we do think that, well, as we said earlier here with inflation, we do think that inflation will remain sticky. But at this point in time, I really can't see inflation sticking at these levels for the next more than 12 months, especially given the Fed is as restrictive as they are. It's not like we're the ECB or whatnot, and we're still far off from having real positive policy rates. The Fed's already there. Now, the way that these deflationary or Fed pivot bond trades work typically is in 3 stages. Okay, it's stage 1. Inflation has to be on the downswing. So, as you said earlier, what makes this bond trade different is exactly that. Let's go back into 2022. The big bond pounding, right? Where everyone got smoked in bonds that was long
Right.
bonds.
It's actually kind of funny, just on the FinTwit space. Everyone was saying, buy bonds, wear diamonds. Everyone was trying to catch the falling knife. And now, when it really feels like there's a good risk to reward ratio on bonds, I'm not really seeing anyone trying to buy bonds anymore. It's
Yeah,
kind
they're
of
too busy
interesting how
trying to
that
short the
works.
market, right? Yeah,
Yeah,
no,
everyone's
it's
trying to short the market, and as we've spoken about in previous podcasts, we don't think equities have that downside potential. If anything, bonds are that's where the opportunity is. Equities not so much.
right. So back to bonds going down horrifically in 2022. Obviously, one of the worst years for bonds in a very long time. That whole regime of negative bond performance was attributed to inflation basically running away from us, right, from the Fed. The Fed did catch up. The Fed is caught up now. But that whole year, this whole last year, was inflation running away from us. So all the simp attempts to long the lows and load up and catch the falling knife failed every single time because of just that. You didn't have the 3-stage program complete, with stage 1 being inflation on the downswing. You had people trying to catch the top on inflation, time the top on inflation, which we know didn't even peak until mid to late 2022. But the anticipation of where the Fed would go was still unknown until the end of 2022. So again, that was a big shock to markets and whatnot. But long story short, inflation was the unknown picture in 2022. So people were chasing bonds, and inflation was unknown to the upside with the Fed so far behind. Remember, it was the idea that we didn't know when the Fed was going to catch inflation. Bonds were very unfavorable. So step 1 for the bond trade is you're going to need inflation on the downswing. Step 2, you're going to need the Fed to pause. You can't have a bond trade simultaneously occurring while the Fed is hiking rates. Doesn't make sense, because if the Fed is still hiking rates, obviously the market is going to price in that the Fed is trying to catch up or control inflation, meaning inflation is still uncontrolled. So basically, by longing bonds while the Fed is hiking rates, what you're doing is you're fighting the Fed, which we don't want to do that, especially given that component of the inflation trajectory is unknown. So that's step 2. Step 3 is you need data deterioration to come in within markets to really facilitate that leg up into a recession. That's when you want to own bonds. You don't want to own bonds when the market's when the economy is booming, everything's going well. That's not a time to own bonds. That's when you want to own risk on assets like equities, um, even Bitcoin. Those are the things that you want to own in great economic times. What you want to own in recessionary or doom and gloom times is going to be bonds and gold. Now, for the bonds and gold to happen, you need that stage 3 or step 3 of the program, which is going to be the data deterioration, and the bond market will pick that up. We would start to see that in the break evens. They'll start to fall more aggressively, really break out of this range and go lower. And we'll start to see bonds pick up, flip trend, and start grinding higher. Until you see that, though, it is not the trade, meaning chasing bonds. We've said this for over a year now. Bonds have a high probability of chop. And we're more than right on that. I mean, we came out saying bonds can chop. I think it was like over here, to be honest with you.
Right. Yeah.
And bonds have done nothing but chop. And that's because now some could argue I collected my dividend. I understand. But we play with leverage, and when we play hard. So the dividend doesn't mean anything to us. We're here for the capital appreciation. Unless that happens, bonds, we're not in the bond trade. So what does that all mean now? Your head's probably spinning. You're like, how do I know what to do or when to do it? And this goes back to our system. We have an economic and market regime model that spits out data every single day that gives us insight on where it thinks the market is going in the short term, and our models use that data and spit out positioning sentiment and positioning direction for us to use in our trading. So we use everything that we do, or pretty much all of what we do, is quant approached. We're not here sitting around thinking of different ideas, portfolio strategies in terms of like any type of discretion. It's really just down to the rules. Follow the rules. If the strategy works over time and if you follow the rules, you will win. That's how we approach markets. And so far, we've had a lot of success doing it. We've avoided a lot of this noise. And long story short, we have been on the right side of the risk-off trade for a while now. Going forward, we'll see how it trades, but we expect a trigger to occur here in the next few weeks. If not, we'll stay positioned and we'll continue navigating from here.